Hey everybody, welcome back to today's Market Explained, a four-star media experience. I'm Brian Castle, your host, and I'm here with my co-host Chris Reardon. Chris, welcome to the podcast.
Glad to talk a little bit about the markets.
And here we are back to talk about what's going on in the financial markets we are taping today on August 12th, a Tuesday, and we've seen a lot of interesting things and even more interesting things yesterday. But Chris, why don't we start out with what's going on in all the different indexes, right? And where are we versus the other indexes?
Yeah, so from an asset class perspective, continuation of what we've seen probably over the past couple months, but domestic equities is still leading the way. It is by far the leader. It's at 264 now, and it's gained 4 points. So it continues to kind of pull away,
Okay.
especially from commodities. International equities is there, but from a movement standpoint, one domestic is moving, it seems like international is moving. So it's not gaining any distance there. International is non-domestic yet with the trends we've seen. Going to international equities in the number two position, that's at 250 tally points, and it gained 4 points as well from the last podcast. Both of those continued to gain strength, and they continue to separate themselves from commodities, which is right now sitting in the third position at 237 tally points. And that was equal from last podcast, so unchanged there. The bottom three, it's been kind of a continuation of the same as well, but in the opposite direction, moving downwards. Cash pulled back 1 point from last podcast to 129 tally points. Currencies pulled back 4 points from the last podcast to 115, and fixed income deteriorated 2 more points to 95 and is in last position there. Mostly, I would say more of a risk on environment from an asset class perspective with what we're seeing here, albeit commodities. I think we're seeing kind of a stalemate there. You have some winners, some losers within the sub commodity sectors, but as a whole, I think it's been more of a stalemate there.
So, Chris, not a lot of change between the groups, and we didn't see any leadership changes. So, one, two, three, four, five, six are still in the same position. Fixed income looks worse. And until rates start going down, which we understand they might soon, then fixed income is going to be in the tank, right? And
Yeah, totally see that.
that's where we are. Well, and then looking at the general indexes, S&P is up 9.14. It's up 2% since our last show. And so that's full of technology names. And we'll see that because the NASDAQ is up 3% since our last show, up 11.48%. But then all the other indexes are either down or flat. So the Russell 2000 small caps was up only 0.85 for the year, not even quite 1%, Chris, and it's down 1% since our last show. The Dow Jones, the kind of the dividend stock, not completely, but it was always a dividend stock index, up 4.5%, down 1% from the last show. And then the Russell 1000 value, which is more of the dividend names, 5.41, and that's off 0.8% since our last show. So all the indexes are down except for the ones that have technology. So it seems like we're just narrowing and narrowing more and more, Chris, into technology buying, and everything else is just kind of hanging around.
Yeah, I think technology is a big driver. I would also add, you have the derivatives of that technology being utilities, which is the number one sector actually year to date still, up 15.04%. The second best performing sector is communications after that, up 14.8%. Info technology is actually fourth at 12.76% year to date. That drop we saw in April, it had a ways to make up because it dipped probably another 7 or 8% more than the other sectors. It got hit so bad. But the third place position is industrials, and that's up 14.25%. The caveat and why, technology is definitely a piece that's running, I think, under some of those indexes. What you're seeing, that is probably getting dragged down by some other components. But I think the aerospace and defense sector has actually been, particularly the defense side, has actually been quietly pretty strong. And that's really helped that industrials sector as a whole maintain its composure and be at 14.25% year to date as far as return. On the flip side, though, the bottom three that are really dragging, and this is where I think the industrials, especially some of those dividend stocks, it's the healthcare. So healthcare is down 3.81%. So like the United Healthcare, some of these big players in this market, which tend to be dividend producers, tend to be in those indexes, are really getting dragged down by the
Mhm.
healthcare sector right now. After that, you have energy and consumer discretionary, which are both tied, and they're both up 0.09%. year to date. So you almost have a 20 point, a little less than about 19% difference between the best and worst performing sectors so far this year. So that's a big gap there between those two.
Yeah. Well, so it's interesting. That market's narrowing, Chris, and we'll see if that continues. So the S&P goes up, NASDAQ goes up, all the indexes are flat or down, and then we're seeing that kind of movements you mentioned with utilities being the strongest because of all the energy needs. Again, that's also technology because of AI. So the utilities are going to provide the energy, and it's all focused on artificial intelligence right now. We do reviews every week with our portfolio team, and I mentioned to the team this week that we seem to have just like a market that's driven by technology and it's strong enough to be a bull market, but it's so narrow. It's not really the typical one we're going to see. Plus, the economy is slowing down, which we're going to hear here in a minute. Don't know what to make of this market. Bull market, but not exciting.
Yeah, it's a very, and we've said this a lot, but I think it kind of becomes much more impactful when we have the Trump administration on office. It's a very event-driven market. So it's really hard to predict what's going to happen necessarily because Trump likes to be a lot of bravado when he comes out and makes statements and declarations. And so we've seen a lot of volatility sometimes get injected in the market that we couldn't see coming, unless you're in the mind of Trump's head or in the administration, you really don't know kind of what's coming down the line necessarily.
Yeah.
That plays both to the market and against it. I know recently we had the US China extended their tariff truce by 90 days. That's kind of been a boom for the market. So it plays both sides, but it definitely interjects that extra volatility.
Yes. Well, and then under the surface, we have some other interesting things going on, Chris. We have a return of the meme stocks. I mentioned this in our last episode. We've got Krispy Kreme and Kohl's and Open Door Technologies and Rocket. These names were names not doing well, and all of a sudden their shorts were heavy. So to cover shorts, you have to buy back. So people are buying back and the stocks are running. Everybody remembers Roaring Kitty from 2021, this young guy named Keith in Massachusetts who led a team to run GameStop stock from $1 all the way up to $300 at one point, and actually bankrupted a hedge fund that was short that stock. So we're starting to see some of that activity again. Not sure why it's happening now, but it is. But that, and there's going to be a lot of other changes. What else do you see in the markets out there, Chris?
Yeah, why we're seeing this happen right now. I think you have Palantir, then Nvidia's. You have these stocks that are running, in some cases, huge moves up 20% on certain weeks. You're seeing a lot of movement here.
Yeah.
Bitcoin's another one. It's still over 100,000. Bitcoin, I think it's at about 115 to 120,000. It's been trading in that band for a little bit now. So you have these growth of these stocks. And I think some people are worried that they've missed out on it. They see this market froth in some regards. And so they're turning and saying, all right, can we get a huge gain by looking at some of these underappreciated stocks and really bidding them up? So they're kind of playing into, I think, the market ideology that's going on right now, this market fervor that's going on. But, outside of that, I mean, the economics that are coming out, which I'm sure we'll discuss shortly, have actually been, I think, some of them, I think jobs kind of rolling over a little bit, but has been relatively strong, which has helped kind of feed into some of this narrative.
Well, good. So let's go to the economy, Chris. What do you see there?
So the big news that came out just today is the July CPI number came out. It came in at 2.7%, which was actually unchanged from June and actually beat the expectations. Expectations were 2.8%. Core CPI rose to 3.1% in July. That was above expectations of 3%. So a little bit back and forth there. But I think the key is that CPI number is showing that inflation is still remaining pretty tepid for the most part. Obviously, I think the Fed would like it to be closer to 2%. But, what does that mean overall for the market? I think right now what the market's feeding off that is certainly a September potential rate cut is certainly on the table since the inflation doesn't seem to be spiraling out of hand. It's upping the ante for those potential rate cuts, which is probably one of the biggest drivers right now in the market. So anything that's going to impact that is definitely going to play whether the market's going to have a big day up or a big day down necessarily. Overall, the CPI number, inflation numbers overall look pretty good. The National Federation of Independent Business Optimism Index, which is essentially kind of a index of the sentiment of small businesses, that rose to 100.3 in July from 98.6 in June. So, overall, the feeling, especially within small businesses, seems to be getting stronger. They seem to be more confident overall. And then the Conference Board's Employment Trends Index. So this is tracking kind of overall employment trends. It fell in July from an upwardly revised 108.19 in June. That 107 number is actually the lowest number since October of last year. But I would say on the positive side, this number, ETI, the Employment Trends Index, has remained kind of within this range for the last 12 months. So even though we're seeing it on the lower end, we haven't seen it drift significantly. So yeah, there's a lot, I think, going on with the overall market. But I think overall, from a jobs market, it's kind of, I would say, stagnant right now. And we're just seeing if that's going to kind of overall crack, which we haven't seen it yet necessarily crack the jobs market.
Yeah.
And then the couple other things I'll mention, the Conference Board's Consumer Confidence Index. So this feeds, it climbed to 97.2 from 95.2 in June. So that's great. I mean, it shows the overall the consumer is feeling a little bit more confident. We have small business owners that are a little bit more optimistic and confident. That is very positive overall. Switching over to the real estate market, pending home sales actually fell 0.8% in June from May. That was way below expectations. The expectations were a 0.2% rise. That was a rapid reversal from a 1.8% increase we saw in May. So we're seeing the real estate market, especially the home sales market, really start to slow down a little bit. Pending home sales fell 2.8% in June year over year as well. So with maybe these higher interest rates, with the consumer starting to feel better, maybe the potential for rates coming down, we're seeing a little bit of a slowdown from a transaction base on home sales. And then the last two things I'll mention, the ISM Purchasing Managers Index for services, so this is just services, fell to 50.1 from 50.8 in June. So anything above 50 is expansion, but obviously we're getting really close to that 50 and below number there. So that's certainly something to keep an eye on. And then the same ISM Purchasing Managers Index for manufacturing, that contracted to 48 in July from 49 in June. So that continues to contract the manufacturing activity within the United States. So kind of two flip sides there, but overall, I'd say it's definitely kind of from a economic number, it's been relatively stagnant to positive, slight positive up. We're not getting in major expansion territory necessarily, but things I think have held up better than it was anticipated by most economists.
Well, and there's enough things that are trending negative, Chris, that some feel we are going into that recession, that long rumored recession for the last 3 years. We've been saying, oh, recession's coming, hasn't come. But there's enough bad things going on out there, albeit with some numbers going up, that some economists feel that we are finally having the recession. And did we talk about the job numbers and the revisions?
No.
All right, let's talk a little bit about that. The numbers from May and June came out, and both of the employment numbers were up over 200,000 jobs for the month. But then just a week ago, the Bureau of Labor Statistics came out with some massive revisions to bring both of those numbers down below 20,000 for each month. I think 14,000 for one and 17,000 for another. And it was such an extreme change. And when you think of it, if there's any process that can report a big number positive and then basically report a revision to get rid of almost all of that number, if it's not fraud and if it's not politics, there's certainly something wrong with the measurement, because it just seems pretty unreliable. Why give us that number if it's so far off? And so that got President Trump pretty much in a lather, and he fired the head of the Bureau of Labor Statistics the other day. And he's now, as of this morning, on Tuesday the 12th, made some recommendations of people that he'd like to nominate to potentially replace that lady who was there before. And so this has been a big debate, because during the previous administration, many felt that some of the numbers were not being completely honestly reported. And a lot of it was political. And part of the reason is every single revision that came out was always lower than the first announcement. And many of the first announcements before the last two elections were very good. And then they got revised right after the election. And so there were some people claiming that there was politics there. So that was actually part of the campaigns that led to President Trump going back in the White House. That was one of the issues they brought up, that they felt like the numbers weren't being honest, the government wasn't being honest, the government was corrupt, and all those things. So now we have this big revision, but knowing how they calculate that number, in this case, I kind of feel like that number might be accurate, even albeit a terrible system. So I wouldn't say necessarily that this particular number was fraudulent. I think maybe some of the previous numbers had been back during the Biden administration, but this number might not have been. But it was enough to get pretty upset, and he decided to fire his BLS lady. So we'll see how that goes going forward. there needs to be an honest process. And, we know other countries in the world, Chris, or, you can't believe a number coming out of China. A lot of these governments that are controlled by dictators, they just make up a number. We're not sure we can trust any of those numbers. But that's never been the case in America. And some people were worried it was getting there. So now we'll see. Trump has a chance to get someone who's going to do a fair job. And let's hope he does a fair job and not, political the other way, right? That we don't want it. We don't want politics to favor anyone either, as compared to, dinging someone. So we'll see. Then what else do you have for the economy?
Yeah, switching over real quick to the international markets, a couple things to cover there. And the Asia Pacific theater, China. So two things of note out of China. So China's continuing to have deflationary pressures, which is, depending on what news source you look, it kind of has flown under the radar. But the country's PPI, Producers Price Index, fell to 3.6% in July from a year earlier. While it matched the June's number, it continued to the kind of the negative trend, falling, so negative 3.6. So the PPI is already in a negative deflationary. The CPI, which is usually the PPI is kind of a indicator of what's going to be coming. For the CPI in July was flat. So for the most part in China, they're kind of stagnant. They're staying right there. And it seems like if that PPI is any indicator, they could be starting to enter a potential deflationary process there. And this is a big deal because China has really, really tried to, and they have a lot of levers just due to the nature and power of the government there that they can try to pull to counteract this. And they have been unsuccessful so far. So it's certainly something to keep an eye on. And then the S&P Global China General Services Purchasing Managers Index, which is kind of a long tooth way of saying their services market, their services sector, that rose to 52.6 last month from 50.6 in June. So their services sector overall, pretty positive. That's actually positive as far as what we're seeing there. Flipping over to the European continent, a couple headlines out of Germany and then France, which I think is kind of interesting. So German exports to the US fell 2.1% in June, and that marked the third consecutive month of declines. And that's the lowest level of exports to the US, I should say, since February of 2022. But overall German, so outside the US, just overall German exports actually rose 0.8% in June. And that was helped by increase in exports to other EU countries. So even though they're exporting a lot less to the US, they're still exporting positive, Germany, and they're just exporting to their own EU countries. And then German factory orders fell 1% in June, month over month. And that was a big drop. The expectation there was actually a 1% increase. Foreign orders were a big reason that dropped 3% in June. And that was dragged by orders outside of the EU falling 7.8%. So we're really starting to see some of the tariffs bite, especially within Germany, albeit some of it's still being held up within European trade. Switching over to France, the French industrial production rose 3.8% in June from May. And that's the largest increase since the pandemic recovery of 2020. Why I think this is interesting is the notable reason behind this increase was actually a 27% rise in non-automobile transportation equipment. What does that mean? That means it's Airbus. So Airbus has a lot of different operational sites all over the EU, but a lot of them are in France. And they're really ramping up production to try to take advantage of Boeing's missteps and really gain market share there. So we're really seeing that be a slight boon, if you will, for France there.
All right. Well, with the tariffs changing everything, we're going to see big changes in the European economies. Like the Germans are down. China's in big trouble, it seems. If they go into deflation, I know folks hear a lot about inflation, and certainly our listeners have heard a lot about that. But actually, deflation is worse than inflation. Because if deflation happens, that means prices go lower, no one's spending money. And if you know something's cheaper next month, if you just wait, then you're not going to spend any money. So the economy completely collapses because nobody spends any money waiting for things to go lower. And they may not go lower, but they wait anyway. Hopefully, China can turn things around. No one wants to see a declining economy, but it looks like they might be going into deflation, Chris. It's really tough.
Yeah, deflation is the other aspect of that is it's really, really hard to get out of the deflationary spiral because obviously with inflation, which we saw, you can raise interest rates. You can kind of try to curb spending a little bit, which should help rein in some of that inflation. Deflation, it's really hard because what do you do? Do you try to pump more money into the economy? But then, it can be really counteractive almost. It's really hard to get out of that spiral once you get into that, as you said, Brian, because you have less spending. It just everything drags into the economy from there.
Exactly. Well, and turning back to America, there's lots of changes that the president is initiating, and very quietly, a lot of things are happening that people aren't even aware of. They did talk a little bit about the regulation in the EPA that the previous administrations under Obama and under Biden had used a court ruling in 2007 about greenhouse gases. If they're a danger to public health, that they could regulate them. And so they used that to create a full system of regulations, and they were regulating so many parts of American society. The EPA actually now, under Lee Zeldin, who President Trump nominated to run the EPA, is actually reversing all that. They went to the Supreme Court and they basically said, do we have the power to do this? And they determined they really don't have the power to do all that regulating. So they're unwinding all that. So that'll change a lot just as far as efficiencies in companies. And they also got rid of the EV subsidy, the $7,500 per car. So it's a huge power grab in a lot of aspects of American life. And some people obviously believe that to be a positive thing, but it certainly hurt business. It certainly hurt regulation. It was all over the place. So that's all changing. And they used to force anytime a fossil fuel plant closed, it would be permanently canceled and off the registered list of plants that can be opened. So now they're letting fossil fuel plants reopen. So it's interesting, the different administration, different measurements of what they want to accomplish. And also, there's talk now, of course, there's big deficits, and the big, beautiful bill, Chris, that went through did have some deficits obviously built into it. But now we're starting to see the fact that we're not seeing as much importing into the United States because we're buying goods here. And so that's changing the equation. Then also we're getting lots of money in tariff money. So the deficits might not be as bad as people think because we're not seeing the trade deficits and we're not seeing as big a deficits due to a lot of the money that's coming in from tariff payments. So it's really interesting. They made some changes, Chris, in the segregation, the real estate cost segregation that used to be in some of the tax bills that was taken out years ago. They brought that back in the one big beautiful bill. There's a new tax break for real estate investors based on that. And we talked, of course, about the EPA rules. Big oil companies have been seeing lower earnings because prices are lower, but they're using that as an opportunity to buy more reserves. So everyone thinks the energy markets are going to be very positive for the next 5 to 7 years with a favorable administration. But now all of this, because the economy is slowing in certain areas, and we had that really bad jobs number, Chris, it looks like we're leading to possibly rate cuts in September and maybe a couple more this year even.
Yeah, I mean, I think that's right now the projection from a rate cut standpoint. But, I think there's still a lot that remains to be seen. Even if there is a rate cut, I think that'll be a boon overall for the markets. I think, we've talked a little bit about this, the debt, even though, with the tariffs and everything, we still obviously have the debt there, and they're going to have to roll that debt over. And at the current interest rates, it's really tight on the US government. So I think there's outside pressures as well, even outside of Trump and the want for potentially, bigger spending, things like that from the consumer. But one interesting thing I'll note as well, kind of talking about deregulation, if you will, is two other things that the Trump administration is doing and looking at doing is they just announced this week they're looking at reclassifying marijuana as a less dangerous drug. So that'd be a really big deal. I mean, US listed cannabis stocks jumped after this news. One of the main things is right now it's a Schedule 1 drug. So if they made it less, reclassified it, it would remove a tax burden under the Section 280E, which actually denies cannabis companies from being able to take standard business tax deductions. That would be potentially a huge boon. And then the other one, what really flew under the radar, no pun intended, is back in June, President Trump repealed via an executive order the prohibition of overland supersonic flight regulations, which is kind of cool because that really was crimping a lot of innovation. Flights were Concorde, as everyone remembers, but there's an innovative company, Boom Supersonic. It's actually more of a startup, but they're looking to reinvent supersonic flight, bring it back to the masses. A flight from New York to London would be 2 hours on a supersonic flight, cut the time in half, essentially. Really innovative there, what they're doing and what they're presenting to the general market. So I think a lot of this deregulation allows for innovation, American innovation, which is certainly needed.
Yeah. So while we're seeing the economy slow down a little bit, Some things are positive. We're also seeing lots of changes that should lead to a better economy once this recession, whether we have this recession or not, is solved. We should see a stronger economy after that with all the deregulation that's coming in and all the other changes. So it'll be similar to President Trump's initial term, where we had a very strong economy during then as well. So we're hopeful that this is a positive thing.
Yeah, hopefully, if we do go into a recession, it'll be more kind of like a 2022, if you will, kind of more short-lived and not like whenever you hear the word recession, people think 2008, they think big collapse. And hopefully it's just more of kind of a general slowdown from the overall economy.
Exactly. Well, I think we're near the end here, Chris. I know that we do have a couple podcast episodes that are coming out. One that's should already be released. Katie Hubbard from the Walton Group was here to talk about land investing and why they manage land for developers, but there's still 6 million homes that need to be built in America. So we're short. They're adding every day, but population is growing every day. So they really need to accelerate, and interest rates being high has held that up. So new homes are actually cheaper now to buy than existing homes. Really quite interesting the way the markets have played out. So watch that episode. We're also going to have an episode with Ray and the folks at Inspira, which is an alternatives custodian, to help investors learn a little bit about how they can invest in alternative investments in IRAs. So it's very interesting. That episode will be out very shortly. And then I think that's about all we have today, Chris.
Yeah, I think that about covers it.
All right. Well, thanks, folks. We're going to leave it there. We're done. That's it for us today. Why don't we sign off, and we'll be back again in a couple of weeks with another episode. All right. Thanks, everybody. Bye-bye now.